WeWork reached a peak private valuation of $47 billion before its business model collapsed under the weight of its own debt. In 2019, WeWork was the poster child for the modern unicorn. It wasn't just a company, it was a movement. With a private valuation of $47 billion, it promised to revolutionize the way the world worked. But beneath the glass walls and free beer, there was a fundamental disconnect. Investors were pricing work like a high-growth software company, but the actual business operated like a traditional real estate firm. This is the story of how a $47 billion dream collapsed, and what happened when the hype finally ran out. To understand the crash, you have to understand the mechanism. WeWork's business model was based on a spread. They would sign long-term leases with landlords, committing to pay rent for years, and then rent that same space out to freelancers and startups on a short-term, flexible basis. This created a massive asset-liability mismatch. If a startup went under or a member left, WeWork still owed the landlord. They had long-term liabilities but short-term revenue. For a while, this worked because of a narrative. WeWork didn't pitch itself as an office lessor, it pitched itself as a technology-enabled platform. In the world of venture capital, software companies get massive valuations because they have high gross margins. Adding a new user costs almost nothing. WeWork tried to claim that same scalability. But in reality, every new location required heavy upfront capital, construction, furniture, and local operations teams. You cannot scale a physical building with the marginal cost of a line of code. The turn happened in 2019, when WeWork prepared for its initial public offering, or IPO. It moved from the private world of venture capital to the scrutiny of the public market. The S-1 filing, the registration document for the IPO, exposed the cracks. It revealed massive operating losses, crushing lease commitments, and a governance structure that gave co-founder Adam Neumann an unusual amount of control. The public investors didn't see a tech platform. They saw a real estate company with a branding problem. The IPO was withdrawn. Adam Neumann stepped down, and the $47 billion valuation evaporated. Then came the catalyst that made a bad situation terminal, the pandemic. COVID-19 didn't create WeWork's problems, but exposed them brutally. Remote work became the norm. Office demand plummeted. WeWork was still locked into those long-term leases, but their members were staying home. The company burned through billions trying to survive. They attempted a SESTIPAS merger in 2021, a special purpose acquisition company, which is essentially a shell company used to take another company public, at a valuation of roughly $9 billion. It was a fraction of their peak, but it bought them time. By 2023, the end was inevitable. In May, Fitch Ratings assigned them a CCC-issued default rating, stating that default was a real possibility. By August, the company warned in a filing that there was substantial doubt about its ability to continue as a going concern. The market capitalization had fallen to roughly $270 million. Shares were trading near zero. On November 6, 2023, WeWork filed for Chapter 11 bankruptcy. This is a specific type of bankruptcy that allows a company to keep operating while it reorganizes its debts. At the time of filing, the company was worth less than $50 million. SoftBank, their primary backer, disclosed a cumulative loss of $18.6 billion on the investment. But the aftermath of the bankruptcy is where the story gets interesting. Most people expected the doors to close overnight. They didn't. The bankruptcy process allowed WeWork to do three critical things: exit expensive leases in underperforming markets, negotiate better terms with landlords on the spaces they kept, and restructure billions in debt. Specifically, the company used a restructuring support agreement to convert roughly $3 billion of funded debt, including first lien and second lien notes, into equity. In plain language, the people the company owed money to became the new owners of the company. On May 30, 2024, a judge confirmed the plan, and on June 11, 2024, WeWork emerged from bankruptcy with a debt-free balance sheet. Today, WeWork still exists, but it is a different animal. In New York City, for example, over 70 locations remain open. The coffee machines still run and the memberships still work. But the vibe has shifted. The talk of being a lifestyle brand or revolutionizing the world has been replaced by a quiet focus on profitable locations. The luxury touches have been trimmed, free printing is more limited, and the flashy networking mixers have been replaced by practical workshops. WeWork survived its collapse by becoming boring. It is no longer a unicorn trying to change the world. It is a mid-range coworking provider. It offers a lesson in the danger of the software narrative. When you dress a capital-intensive business in the language of a tech startup, you don't change the economics. You only increase the height of the fall.